Hello friends, welcome to Finance MCQ. I am CA Pritam Sangwan and today we will continue our discussion on sources of finance, which is part of finance subject related to paper 2 of SEBI Grade A exam 2020 journal stream. Friends, this technical syllabus is of 100 marks in phase 1 and it has 2/3 weightage in phase 2 of your SEBI Grade A exam. And friends, you can find entire technical syllabus of SEBI Grade A exam chapter wise, topic wise on Finance MCQ website in MCQ question format. You can visit the website and practice entire technical syllabus there. I have put the website link in the description box below. So let's begin. Friends, we just quickly revise what we have so far learned in the previous video. We have discussed sources of finance, which is divided into two parts, external and internal sources. In external sources, we have share capital, in which we have discussed about equity share capital, preference share capital, types of preference shares, and then we talk about debts and borrowing as an external source of finance. In that we have discussed debentures, categories of debentures and various types of debenture. So if you haven't seen that video, please go and check that out. And let's start our discussion on external sources of finance. Friends, in external sources of finance, we have already discussed share capital and debentures. Now let's discuss bonds as an external source of finance. So friends, what is a bond? They are fixed income securities which are created to raise the funds, and these funds can be raised through public issue or through private placement. So let's move further and discuss types of bonds. So friends, based on call, bonds can be either a callable bond, which gives the issuer the right to redeem the bond before maturity at a predetermined price. Here friends, it gives the right to issuer. Now who is the issuer? Issuer is a person who issue these bonds. So they have a right to redeem the bond, and that is before maturity. That if bond period is 10 years, so he can redeem them say after 5 years at a predetermined price. So that is a callable bond. Then you have puttable bond. Now in this bond, it gives investor a put option. Now what is put option? It is the right to sell the bond back to the company before its maturity. Here remember friend, here in puttable bond the right is with the investor, and in callable bond the right is with the issuer. So here the investor has a right to sell back the bond to the company before its maturity. So in same example, if it is a puttable bond and the bond having a maturity value of 10 years, maturity period of 10 years, so after say 6 years an investor can sell back the bond to the company if it is a puttable bond at a predetermined price or whatever the price they have agreed upon. So these are the type of bond based on the calls. Now let's move further and discuss some other types of bonds also. So friends, the first one is FCCB. What it is? It is foreign currency convertible bond. It comes at a very low rate of interest. Friends, the main advantage to the issuer is that he will get foreign currency at a very low cost. Then we have plain vanilla bond. Now what is this plain vanilla bond? They are the simple bond and does not have any options attached to it, like callable bond or puttable bond. In that, issuer will pay principal and interest amount, and it can be discounted bond or coupon bearing bond. Now the third type is drop lock bond. So what is this drop lock bond? So friends, it is a floating rate bond which convert into fixed rate bond. Here what happen, if interest rate falls below a predetermined level, say for example this bond is having a floating rate of interest, but they have agreed that if say for example if interest rate fall below 7%, then the interest rate will be fixed at 7. It won't go down and it will continue being at 7% till the maturity of the bond. So that is a drop lock bond. Here what say, the fixed rate will continue till drop lock bond reaches its maturity. So I hope it is clear. Now let's move ahead. Then we have another type, which is Yankee bond. Now what is this Yankee bonds? Friends, it is denominated in US dollars and issued by a non-US entity. That is, non-US company will issue this bond, and these are issued in USA to raise dollar. Say for example, if you want to raise dollars in USA through a bond, you will issue Yankee bond. Condition being, you have to be other than a US company or US entity. Then you have a samurai bond. What the samurai bond means? It is denominated in Japanese yen. Like Yankee is in dollars, these are in Japanese yen, issued by a non-Japanese company. That is, the issuer has to be a non-Japanese company, and where it is issued in Tokyo, Japan. So basically it is issued in the Japan. So Yankee bond for raising dollar in USA, samurai bond is raising Japanese yen in Japan by a non-Japanese company. Then we have a third type. What it is? It is Euro bond. Now what does Euro bond means? These are the bonds denominated in one currency and issued outside that currency central bank jurisdiction. Friends, these are typically issued by MNCs, multinational corporation. Say for example, German company issuing Euro bond in United Kingdom for raising dollar. So here, if you have noticed, I have said that German company which is issued Euro bond in United Kingdom. So in Germany, what is the currency? Currency is Euro, but it is raising in United Kingdom, whose currency is pound. So it is issuing outside the jurisdiction of Central Bank of Germany and in a third country. So that is Euro bond. Here friend, one thing is very important to remember, that the term euro is nothing to do with Europe in Euro bond. It is just to use to reference deposit outside jurisdiction of domestic central bank. So I hope it is clear. Now let's move ahead and discuss other type of bond also. Then we have bulldog bond. Now what is bulldog bond? It is denominated in Great Britain pound, issued by non-UK entity and issued in London. Like Yankee bond and samurai bond, they are for the respective countries. Same way, to raise pound in United Kingdom, you have to raise bulldog bond, and the condition being you have to be a non-UK entity, that is other than UK company, you can issue bulldog bond. Then we have masala bond. Friends, it is an Indian bond denominated in INR, issued by an Indian company outside India. Remember friend, in all previous bonds, that is bulldog bond, samurai bond, Yankee bond, the respective home country cannot issue those bonds. It is other than the home country company which can raise the bond. The masala bond is for Indian company who wants to raise money in Indian rupees, and that is outside India. Like for example, NTPC raises 2000 crores through masala bond. So this 2000 crores raised in INR but outside India. So that is masala bond, one of the Indian bonds we have. So I hope you all understand different type of bonds. We have covered all the important bonds. Friends, you need to know which bond is associated with which country. Like masala bond is associated with India, bulldog bond is with UK, samurai bond with Japan, Yankee bond is associated with America. So now let's move further and discuss next source of external finance. Now we have loan from financial institution. Friends, the Indian institutions from which we can avail loans are Industrial Financial Corporation, then we have IDBI, ICICI, LIC, UTI, etc. So these are the financial institutions from which we can avail the loan and are part of an external source of finance. Here IDBI and ICICI were earlier financial institution, now they are the banks. Then we also have some foreign institutions which provide loans, that are World Bank for big projects, you have International Finance Corporation, or you have Asian Development banks. Friends, these are some of the important Indian and foreign financial institutions. You won't be asked in-depth questions from all this, so you just need to know which are these sources. So now let's discuss other sources of external finances. In that, first we have venture capital funding. Friend, this venture capitalist, they fund new highly risky businesses or ventures. They provide equity finance or loans which may be at a higher rate of interest. Then we have lease financing. Friends, you can procure any assets on lease for your business, and the lease is can be of an operating lease or finance lease. Then we have short-term finances, which includes your trade credit, advance from customers, commercial papers, or etc. for a shorter period of time. Then we have intercorporate deposits. These are the borrowings by company from other companies in forms of ICDs. These are basically taken from your relative company or related party companies, that if one company is in need, this subsidiary or sister concern will provide the funding to that through ICDs. Then we have treasury bills. Friends, these are issued by Government of India to meet its short-term borrowings requirement, and the period range from 14 to 365 days. Then we have certificate of deposits. It's like a fixed deposit certificates which have a fixed maturity period. So friends, like this there are many other sources of finance. We have covered some of the important one and not considered bank loans or etc. because those you have already heard about. So I hope these sources are cleared. Now let's move further. Friends, in sources of finance we have talked about external sources of finance. Now let's talk about internal source of finance. In that we have retained earning. So friends, retained earning, it is an accumulation of profit of the company. The profit is plugged back into the business for expansion or investment purpose. It belongs to the equity shareholders only because it's a profit, and it increases the net worth of the company. Further, there is no risk and no dilution of control. Why no dilution? Because they are not issuing any extra share capital to outsiders, which leads to dilution. So friends, retained earnings are part of a company profit and can be used anytime, and it is an internal source of finance. So it's a very simple one, not difficult one. So friends, in sources of finance we have covered external sources. In that we had share capital, which is further divided into equity shares and preference shares. We have then talked about debts or borrowed capital. In that we discussed debentures and bonds. Then we discuss about loans from financial institutions. Then other sources of external finance. Then we talk about internal sources. In that we talked about retained earning. So I hope friends you all find this PPT useful and help you all to understand the various sources of finance. Friends, for more practice of this topic in MCQ format, I request you to please visit Finance MCQ website. It has entire SEBI graded technical syllabus, which is paper 2 of journal stream in MCQ format. It has 2000 plus subject wise, topic wise MCQ questions to practice. We have added explanations for correct answers wherever required. It also has 25 test series for your technical syllabus to practice. So friends, there is lot of study materials to practice on Finance MCQ. Do visit the website for more practice and increase your selection chances. Friends, website link is in the description box below. I will come up with new video. Till then, take care and thank you so much for watching.